Well, good afternoon, everyone. This is Steve Albert with Allstate Appraisal. Welcome to our webinar today regarding third-party oversight. Hope you're all braving the cold weather we've had so far this extended winter from essentially coast to coast with only a couple of exceptions. We're calling from Chicago today. I'm the president of Allstate Appraisal. This is our second in a series of webinars we're conducting on topics of interest and importance to the industry. And this particular webinar today is part one of a two-part series addressing third-party oversight of appraisal management companies specifically. Since we have 30 minutes to conduct this webinar, we'll be conducting just those bullet points that are specific to the appraisal management company industry and their oversight by the lenders and other entities who rely upon them. With me here today is Scott Sparks, our National Chief Appraiser, who will be conducting most of the body of the webinar, and then I'll be coming back in for questions throughout the webinar and at the conclusion. Third-party oversight is front and center for all of us right now. We're all in this together. AMCs and lenders are reeling from what has been over the past several years pretty much the main focal point of our managerial meetings, of our strategy, of our operations. Every component of our business model is now focusing around compliance. The stakes are higher than ever. It's just a matter of time before the state board members, the regulators, scrape off the dust and find time to begin pursuing audits of AMCs across the country and, of course, of lending institutions as well. The OCC states very specifically that a bank should conduct due diligence on all potential third parties before selecting and entering into contracts or relationships. They shouldn't just rely on their familiarity with a specific AMC or third-party provider is a reason for utilizing them. There should be an in-depth assessment of all third parties being considered to perform the services they're providing to the lending institutions prior to selecting them. This particular infograph to the right on oversight and accountability is pretty much the focal point of our business model every day and the lenders who we do business with. To get approved to work with any lending institution who utilizes AMCs, there's a due diligence and third-party vendor selection process. Usually begins with an RFP, as we all know, and there could be sometimes either a few or sometimes dozens of AMCs across the country competing for that specific business. The level of due diligence in these RFPs today exceeds anything that I've seen in my 27 years in this industry. It's very comprehensive, it's very invasive, but it also absolutely precludes an AMC from submitting information that they don't have the ability to provide to their clients. The auditing process, which we'll be getting into later during this call, will absolutely secure that for the lenders who use our services. Once the AMCs have been selected, then we begin our contract negotiations. The contract negotiation process for an AMC can be very time-consuming. We include attorneys, just like the lenders do, to help us make sure that the language in those contracts don't just protect the lenders who we're working with, but protect us as well, and align our responsibilities in working for those lenders limited to just the services that we're providing, nothing more, nothing less. Those contracts do require very careful deliberation, and as Scott Sparks will attest later on during this webinar, some AMCs will spend considerable time reviewing those contracts before they submit them back to the clients who are considering using them. And other AMCs, anxious for the business, will sometimes just sign and ask when the orders will start flowing. Once the contract negotiations are completed and the work starts flowing to those AMCs, a big portion of compliance today will deal with ongoing monitoring of those appraisal companies. And that is going to be probably the brunt of this webinar today. Once you're using the AMCs, how do you keep them on the straight and narrow? How do you audit them? Obviously, the termination portion of this oversight and accountability pictograph or infograph is not a large topic that we'll be addressing today, but what's an appropriate term of the contract? With the regulatory environment changing so rapidly, are multi-year contracts even feasible or reasonable today? We think not. So to get into the discussion is Scott Sparks. Scott is the former chief appraiser of a Big 12 lending institution, and prior to that a top 5, I don't mean big, but a top 5 lending institution where Scott was responsible not just for ensuring the quality control protocol relied upon by his own staff and the AMCs who he relied upon, but also vetting them in the RFP process, monitoring their performance through scorecarding and partnership calls, and ultimately performing the audits with his teams. So without further ado, Scott Sparks.
Great, thanks, Dave, and thanks everybody else for joining the call. I know your days or schedules are busy. Obviously, with the scrutiny from the regulators and the changes that seem to be happening daily, if not, even hourly. Sometimes it feels like I'm sure all you guys are aware, and spent most of 2013 like I did, sitting in meetings and talking about all the changes that were coming in January of this year. So obviously, most of you are regulated. If you're a lender, at least, you're regulated by the OCC or the FDIC. And all of them are beginning now. It used to be everything was focused on, modifications and foreclosures, and that was coming out of the housing market collapse. Now that those things have corrected themselves for the most part, and obviously that's still ongoing to a certain degree, but at a much lower level. Now they're beginning to focus on, okay, how are the lenders doing business, and who are they doing business with? So if you're outsourcing to a third party, how is it being done, and to make sure you're doing it correctly. So those are audits that you can expect, and I'm sure many of you have already gone through it, whether it be from the OCC, the CFPB, the FDIC, and even the agencies coming in and doing internal audits and wanting to know how you set up your third-party contracts and things of that nature. So we'll dive into that today. But just a couple comments here from the OCC that shows you that it's not something that's on the horizon. It's here today. And they're coming, and they're going to be looking, and they're going to be turning over every stone and asking you lots of questions. So the key is to be prepared for the questions. If you can read here from some comments by Darren Benhart, the Deputy Controller for Credit and Market Risk for the OCC, he's basically said, we have recently completed reviews in a number of institutions of all sizes. That includes community, mid-sized, and large banks of the collateral evaluation process. The appraisal and evaluation areas probably didn't get as much attention, which may be one of the reasons in a number of those institutions they found weak governance of those programs. He goes on to say, we sometimes found little oversight of appraisal management companies. In some cases, bankers didn't even understand how appraisers were selected and engaged on behalf of the bank. So as you turn to the next slide here, even the CFPB has weighed in, and it talks about, what the lender's expectations are when they're going to hire a third party, overseeing their business relationship with service providers, ensuring compliance with federal and consumer financial laws. And then we even go on to the next slide here, where the interagency appraisal and evaluation guidelines have also made a comment as to third parties and what the expectations. And I won't read both of these, but I will read the bottom part. If an institution outsources any part of the collateral evaluation function, it should exercise appropriate due diligence in the selection of a third party. This process should include sufficient analysis by the institution to assess whether the third-party provider can perform the services consistent with the institution's performance standards and regulatory requirements. An institution should be able to demonstrate that its policies and procedures establish effective internal control to monitor and periodically assess the collateral evaluation functions performed by a third party. Okay, so these are outlines. So we've seen quotes now from the OCC, we've seen them from the CFPB, and even the interagency appraisal guidelines. So moving on from there, what should you expect, what the lenders should expect from their AMCs in 2014, and even after that ongoing. This isn't going away, it's here to stay. First of all, the quality operations management. Okay, this isn't just an AMC that says, hey, we got a president and he's going to monitor your account for you and make sure it's going correctly. This is going to require a staff of management to make sure that that AMC is doing what they're telling you they're going to do for you. So do they have operations managers? Do they have quality control managers? Do they have vendor managers? Well, those things are very important to make sure they're delivering a quality product to you, because at the end of the day, that's what you're going to be judged on. That's what you're going to be audited on when the auditors come in to look at your programs. An auditable vendor management. How is that appraiser being selected? Can your AMC explain to the auditor exactly why that appraiser was chosen for that particular assignment? Was it proximity? Was it the appraiser was the best? Are they scorecarded properly? There's a lot of questions, and we'll dive a little bit deeper into this into our webinar in 2 weeks, where we dive into the audits and questions that you should ask your AMCs so that they can prove to you that they're doing what they're saying. We move on to the next bullet point, dedicated account representatives. There should be somebody at each AMC that is dedicated to your account. Most AMCs have multiple lenders they're working for. They should have a dedicated staff and a dedicated account representative that knows your policies and procedures, knows your guidelines, is making sure that the appraisers that they're assigning the appraisals to understand what you're asking for and what is needed to satisfy the quality that you're looking for. An auditable quality control functions. Yeah, you don't want to make sure that your AMCs have the proper management and the proper controls. Who's reviewing those appraisals? You know, do they have licensed appraisers? Are they offshoring some of these things? Are they just running an automated rule set? All those things in combination can go to delivering a quality appraisal, but you need to know exactly what they're doing. They should probably have a chief appraiser who's going to provide guidance, preferably somebody who's does have some experience with working with lenders to give them guidance on exactly what they're looking for. In today's world, a full-time compliance team, this isn't a part-time job anymore. I can tell you that most AMCs, it takes at least one person, if not a team of people, just to keep up with the state compliance that are changing daily. Every day there seems to be another state that's coming out with new guidance on what they expect and what their laws are in regarding to AMCs and how they do business. Just for instance, I know Texas and Utah and even Louisiana have specifics on how many appraisal reviews the AMC has to do when they use an appraiser. So if an appraiser is doing business for this, they require a certain percentage of those appraisals to be reviewed by another licensed appraiser within that state to make sure that they're following USPAP and they're meeting FIREA guidelines. So those are things that you're going to want to make sure the AMC you're working with is in compliance with any state that you do business within. A documented history of performance. How long have they been in business? Have they documented that they can perform at a high level working with many lenders? And again, that's not saying that you can't get good quality from a new startup company. That's not what I'm saying at all. I'm just saying a lot of times you want to see their past performance. What have they been doing? How have they been scorecarded? Can they continue to perform at higher levels for several lenders? Very important piece right here, financial stability. Look into the financial background of the AMC you're working with. How long have they been in business? Where are their income streams coming from? Is it just from one lender or is it from multiple lenders? Again, we've seen many large AMCs go out of business. We've seen small AMCs go out of business. My guess is moving forward in 2014, the volume has slowed down significantly. What we're hearing across the board is about a 40 to 60% drop in volume since this time last year. So what does that mean? Okay, that means less volume for the AMCs. Are they all going to be able to stay in business? There's probably going to be a mixture of people shutting down, or maybe even some joining of AMCs to make sure they can meet today's deadline. But what you don't want to be is you don't want to be in a situation where you're only dealing with one AMC. That AMC is struggling to pay their appraisers, and they're borrowing today's money to pay for yesterday's appraisal. So again, something you want to look at. A diverse client base. Where are they getting their income streams from? Are they just working with lenders? Are they getting review work? Are they working with the FDIC? How are they making money? And then a true business continuity plan. And if there were a natural disaster, they have multiple locations, or let's just say that there was a technology failure at one of their sites. Could another site perform the same function so that the lender is not losing valuable time in ordering appraisals? Very important. I can tell you, we were very suspect when I worked at the last lender I did when we were going through the contract negotiations. When we sent an AMC the very initial contract and say, here you go, here's our contract, and then we would get it back the next day and it was signed without any red lines. I really scratched my head and said, did they really read that? Are they really understanding what we're looking for? Again, there's a lot of stuff that goes into it. So moving on to the next slide, we'll talk about written contracts. And the institution should have a written contract that clearly defines the expectations and obligations of both the financial institution and the third party. Again, it starts out with a master service agreement, and then you dive into the service level agreements. Okay, so we talk about turn times, appraisal quality, reassignments. Does your AMC have a dispute process? Do they have a rebuttal process? We talked about this just a second ago. How is their compliance to state laws? Do they have a staff of people They're making sure that the states that they're doing business in, that they're complying with the individual state laws. Prices and responsibilities and expectations. Are they paying a reasonable customary fee? Again, a lot of lenders have moved on, and even the lenders I worked with previously, they set their own reasonable customary fees. A lot of lenders don't. They allow the AMCs to choose what they're going to pay the appraisers. It's still your responsibility if you're going to hire a third party to know exactly what they're paying the appraisers, okay? And appraiser independence requires reasonable customary fees to be paid. So you're going to want to make sure that the AMCs and or yourself are establishing reasonable customary fees. An appropriate enforceable consequences for violating any compliance-related responsibilities engaging in unfair, deceptive, or abusive acts or practices. Does your AMC, are they having E-list meetings? When they find an appraiser who is not following USPAP or has violated significant USPAP errors that result in an evaluation issue, if they've committed or maybe committed some fraud of some sort, or maybe just aren't providing the customer service levels or the quality explanations needed in an appraisal to make sure that the lender is protected. What are they doing? Are they contacting the state boards? Are they forwarding these appraisals? Are they turning the appraiser into the state board as they have to do according to the law? Are the lenders looking at these things? Are they asking for the AMCs to show them their E-list, to show them the minutes from their E-list meetings? These are very important topics because I can promise you that I've been in these meetings before where the auditors are asking you, how many appraisers did you put on your E-list? How many AMCs are you using? How many appraisers did they put on the E-list? Did you turn them into the state? Okay, so these are things that you want to pay particular attention to. Moving on to the next page. So once you establish the contract and you begin doing business with an AMC, you're going to want to monitor them, and that doesn't mean once a year or maybe even or twice a year. This is an ongoing monthly thing, a weekly thing. Okay, so you want to be scorecarded. Okay, and the AMCs want to be scorecarded also. So you're going to want to do a good scorecard. You're going to measure service levels, turn times, disputes, how quickly things were answered, things of that nature that are important to your customers, but you also want to measure the quality and the changes that are going on, how quickly they implement changes when needed. These are all things that should be transparent. We loved it. In fact, the lender that I worked with previously, we shared the names of the AMCs we were working with, and we had a monthly scorecard meeting with every one of our partners, and we told them exactly where they stood, where their mistakes were, and even more importantly, we told them what they were doing well. It's not one of those meetings where you just get on to a call and you say, hey, you missed this, you missed this, you missed this. You also pat them on the back and say, hey, you know what, you guys are doing great here. Look how you rank #1 in this particular area. Keep doing that. However, here's a couple things we've noticed that maybe you can fix or maybe you can improve on. Again, that's what we were just talking about, scheduled service level partnership meetings. Again, it's very important, and it's required by you now to make sure you know what your AMCs are doing. And to be honest with you, now that I'm working for an AMC, we love to have partnership calls because we want to know exactly how well we're doing against our competition. We want to learn. We want to be able to do better for you, and that requires these type of calls. Updating contracts. As we mentioned earlier, it seems like there's a weekly change coming from our regulators or the agencies. How often should you update your contract? How long should a contract be with an AMC? I would suggest no less than a year. Once a year, you should look at your contract, regardless of how many AMCs you're working with, and make sure that any changes are noted and are reflected in the contract. And then last, a biannual or yearly on-site audit. These are things, again, we did it at my old employer. We went to our AMCs at least twice a year. We went once in June, July, and we went once in November and December. And we knocked on the door, and they knew we were coming, of course, but we knocked on the door, and we asked them several questions. We looked at everything that they did. We wanted to make sure they were doing what they told us they were doing. But just because an AMC tells you they're doing something, it's still your responsibility. You still need to make sure that they're following through on all the things they told you they would do when you brought them on. So first thing, and again, this is another area that in 2 weeks from today, on the 18th, we'll really dive into this, and we'll show you exactly what we did and what we've seen other lenders do when they're coming in to audit their AMCs. They're first looking at the appraiser selection process. How did you choose that appraiser? Why did you choose that appraiser? What are the qualifications? Was he competent? Was he geographically competent? Second, we talked about this just a bit ago also. What was the fee paid to the appraiser? Was it reasonable customary? Again, that's an appraiser independence, and we don't want any violations of that. We want to make sure that the AMC is either paying what you told them to pay the appraiser, or they're paying the reasonable customary fee, and they should be able to show you how they establish reasonable customary fees. Don't be afraid to ask that. Very important, the timeliness of the payment. Many states now are requiring that the appraiser be paid within 30, 45 days, maybe up to 60 days after the appraisal is performed. Make sure that those timely payments are going out to the AMCs, because you're going to be the one that's held accountable for that. I would say a good rule of thumb is to expect your AMCs to pay within 30 to 45 days, if not sooner. And then quality control. Show me what they did. Did they just run a rule set, or did they provide comments? Were they actually picking up that appraisal, looking at it from page 1 to the last page and making sure it reads correctly? If it was a ranch, were there ranch subject photos? Or all the I's dotted, were the maps and location maps and all those little things that every lender has that are specific to them, were they all in there? Did somebody pick it up and review it? And that's a very important piece. And again, like I said, we'll dive into that in 2 weeks from now, because I'm sure most of you guys are very interested in that piece. But we wanted to hit it at a high level today, and then we'll dive in more particulars in 2 weeks. So moving on.
Scott, I'm going to step in right now because we've got about 9 minutes left, and these webinars go so quickly when you're having as much fun as we're having discussing compliance. So,
okay, great.
Here are some general questions that we've received today, and these are questions that everybody asks. You may have some of the answers from your perspective of a former chief appraiser at a lending institution, but these are valid questions that the lenders who are on this call today have considered, I'm sure. We've all wrestled with it. From an AMC's perspective, we would love to be the only provider of a service to a lender. Selfishly, that's your knee-jerk reaction. You'd like it all yourself. But in reality, the more AMCs you're competing with, it just breeds excellence. You're competing with your peers, and it results in better performance. So the question is, how many AMCs is ideal, if you can answer this question, for a mid to large-sized lender?
Yeah, that's a good question. And again, this is just my opinion, but I can tell you from being on that side, 1 is probably not enough, and more than 5 is probably too much. And the reason I say 1 is probably not enough, we talked about financial stability and some of the issues that may happen, or if something happens to go down. The reason you want more than 1 is because of that. If for whatever reason, the AMC that you choose, and have had good business relationships over the years, for whatever reason, they're not going to make it. If they go down, then what do you do as a lender? So I would always suggest at least have more than 1. I would even say even more than 2, because if you lose 1, then you're back down to 1 again. So the perfect number, in my opinion, would be in that 3 to 4 and no more than 5 range. And the reason why I say do you cap it at 5 would be because obviously with all these regulatory requirements requires you're monitoring the monthly meetings we talked about, and now even the on-site audits. Those are expensive. Those aren't cheap. That means you're taking airfare, you're driving, you're spending hotels, and those are all cost containment items that the lender's trying to contain to still make a profitable margin on their loans. So I would say if you had 3, 4, 5 really good AMC partners that you can count on, that would be the ideal number.
Okay. Scott, does it make sense for a lender to only align themselves with the specific size AMC? There's super large major nationals. There's small to mid-sized regionals. They all have their strong sets. Some have some weaknesses. What do you think would be an ideal situation for a lender, or does it simply depend upon their size and preference?
Really, it depends on their size and their preferences. Obviously, there's probably pluses and minuses to everything. Obviously, a large AMC maybe has larger panels and things of that nature. However, I don't think the size matters. It's can they do what you hire them to do? Okay, I can tell you that I've dealt with small AMCs, I've dealt with medium-sized AMCs, and I've dealt with large AMCs. All of them, for the most part, that I've dealt with could deal on a national level. They did business in every state. They had a large panel of appraisers. Many of those appraisers on one AMC or on the panel of another AMC. It's all about, can they deliver that high quality? Can they deliver your expectations with them on a consistent basis? So and others may say, hey, they love the regional approach, where they want one AMC to say, hey, we want you to specialize in these 2 or 3 states, and they believe, and to be honest with you, we tried that approach where I was at, where we thought, hey, you know what, this might work best. If they can just focus on these 3 states, they can become more familiar with the particular appraisers and choose the best appraisers. it had its pluses and minuses, as we learned, and we ended up going back to, again, a few mixed, small, mid, and large size AMCs where they all did national, okay? And again, it's all preferences, and there's all positives and negatives, but I would say I wouldn't discount anyone for being small, medium, or large. I would vet them out, find out which one meets your expectations.
And on that point, I do know there are some lenders that we've talked to who feel there's benefit in regionalizing their AMCs, and part of the reasoning that they feel that way is, again, to your point, if an AMC is managing work in a select number of states, there's a belief that that AMC might, number one, become more geographically competent in those market areas because they're assigning work there every business day. Some lenders feel that that AMC then builds some allegiance or loyalty from those appraisers who are, instead of getting work from that AMC periodically, are now getting work from that AMC more regularly. And those are 2 points that merit consideration. On the other hand, we've also experienced from lenders who have used, for example, us as an AMC in markets where, say, purchase prices are still higher on occasion than what the market would suggest in terms of recent sales. Well, I guess in layman's terms, where the appraised values aren't coming in all the time at the purchase price, and that catches a lot of negative attention. If there's only one AMC handling the work in that specific market area, I think the knee-jerk reaction from the lender would be that that AMC is the source of the problem. So to have multiple AMCs being active in the same areas, I think would dilute that perception. Has that been your experience as well when you're with a lending institution?
Absolutely, absolutely. And again, I think that goes back to, choosing an AMC. You should probably choose an AMC that share your goals and vision.
Okay. Scott, this question I know that you and I can't specifically answer as appraisers, but we talk to all of our clients and we have our ear to the ground. Do you foresee going forward, now that the dust is going to start settling a little bit and maybe the state board members will have a bit more time to focus on this, do you see down the road in the near future an increase, or at least a beginning, of audits of AMCs by the respective states, 39 states and counting, with AMC registration and regulation in play or in process, and ultimately, of course, there will be 50. So with 39 different state boards performing periodic or consistent audits of AMCs, do you foresee that coming down the road?
I do, absolutely, and I think it'll be here sooner than later. Will it happen this year? That's to be determined. I wouldn't be surprised in 2015 if, obviously, the lenders' audits are increasing, and they seem like there's always somebody in their offices, whether it be the CFPB or the OCC or the FDIC or Fannie or Freddie. I suspect that the AMCs, unfortunately, and ours is going to be very busy, because if you are a national AMC, you're going to be having on-site audits from several states. And like you said, there's 39 states, and they currently have their own state laws and state guidance out there. That's continuing to grow. It'll eventually be 50. But they're going to want to know, and they're going to want to see those AMCs that are doing business in the states, are they following their guidance? We talked about Texas. They're requiring a certain amount of level of review being done by another state licensed appraiser. They're going to come in and they're going to check, and they want to see that you're doing what you're saying they're doing. Are you carrying the bonds? Are you doing the things that they require you to do? I absolutely believe, and I think most lenders, if you're a lender on the call right now, you would agree, it seems like you're being audited every month by somebody. I suspect that those type of audits will happen also by the states at the AMC level.
Okay. The final question that I think we have time for, because we have 2 minutes, is a question that we probably don't have the answer to, but it's worth at least mentioning just to spur some thought. What are the real costs of noncompliance to a lender and an AMC? And I know we can't necessarily monetize it, but we've heard some astounding daily penalties and fines that could be assessed in the event of lack of compliance. Do you foresee this as being a very real possibility for lenders and AMCs alike down the road?
Absolutely, and again, as the audits increase, and they're going to want to make examples of people, and back in my time at the lender, we saw the fees, the penalties that were going to be exposed on lenders if they failed to meet some of these, and they very easily could reach millions and millions and billions of dollars within days. And because they go back and they say how many people knew about the mistake, how many days did they know about it, and it's $10,000 per person, $10,000 per day, $10,000 per loan. These numbers could grow very rapidly. But Steve, it's not only the financial cost to the bank or the lender, it's the reputational risk. It's when you're in trouble, it becomes news, especially if you're a large lender. If you're doing something that you got fined for, I can promise you a newspaper or a news station is going to pick up on that, and they're going to want to advertise that, you know, ABC Mortgage Company or ABC Lender is in trouble for doing this or not doing that. That's a reputational risk that can cost, while the $1 million in fines, that reputational risk is hard to recover from. And again, it's not just the monetary, which can be very, very expensive. It's the reputational risk that could also come in counter with that.
Okay, Scott, well, thank you. You know, these half-hour webinars, we recognize to those who called in, barely scratch the surface. There's a lot of AMCs that we have friendly competition with who also offer webinars on the same types of topics, and we'll attend those, and we try to pick up and glean things of interest. Just talking about it is helpful to us. We're all working together to make sure we're doing things the right way. I personally think that compliance, while it's a little painful, absolutely results in better quality work, better quality business management, and I think it's good for consumers in the end. But right now there's a bit of pandemonium, and these types of webinars we hope are helpful to you, our clients, and our friends that have called in. So thank you for taking time out of your day. We'll look forward to talking to you again or talking at you again on March 18th for those who choose to tune in. Thanks very much and have a great day.